welcome to another Ronel Talks Money show. I just want to remind the viewers, please go and subscribe to the channel. Also, go click on the link in the description field where you can enter our monthly giveaway competition, where you can win one of my books, Financially Fit and Wealthy, as well as various other financial educational tools, books, courses. So subscribe and also enter the competition. Now, today we are going to talk about investing in shares. And this could be for some people a very exciting topic and for other people a very daunting topic. But we hope to get all of you really excited about investing in shares. And we have Charles Savage with us today to discuss investing in shares. So just to introduce Charles, he is the Group CEO of the Purple Group, a fintech company and a pioneer in making the stock market accessible for all South Africans. The Purple Group continues to grow from strength to strength under Charles's leadership, with EasyEquities being one of the 4 platforms they offer. So Charles, welcome and thank you so much for joining us.
It's an absolute pleasure, and thanks for taking the interest and having me on your show.
It's only a pleasure. I think people can learn so much and also get involved in what you are offering. But maybe we can start off and you can just tell us a little bit more about EasyEquities and what you do.
Cool. So EasyEquities is 6.5 years old now and was founded on the premise that it wanted to make all things in investing easy for everyone and essentially democratize access. Prior to EasyEquities launching, about 5% of the South African population had affordable access to investing services like investing in shares. And we wanted to ensure that every South African, regardless of income group, education, age, preference, had access. And so EasyEquities was built with this deep desire and purpose to provide access to shares for all South Africans.
I must admit, I'm also using EasyEquities as my platform for investing in shares. And I must admit, it is really easy. So anybody can do it. But I think, Charles, let us maybe just move a step or kind of I can start at the bottom by just explaining investing in shares, or some people refer to it as stocks or equities, but just explain it to us in layman's terms.
Yeah, look, I think the first thing to understand is that, when you've got excess capital or you've got some savings, then you've got to put those savings into productive assets to ensure you get the best possible return. And the most productive asset class in the world over the last, decades, hundreds of years, has been investing in shares. So they produce the highest level of return versus other forms of investing. And what is investing in shares? Well, essentially, you're buying into a company, ownership structures, and taking a small part of that ownership. And in return for that ownership, you get dividends and capital growth. And depending on the kind of companies you're investing in, sometimes it's a balance of those things. So there are lots of instances where people will buy high dividend yielding stocks, which is essentially stocks or shares that produce a higher level of income, which they distribute back to members or shareholders. And on the other end of the scale, you have what we call high growth stocks, which are companies that are growing really fast, but using all of their cash to continue to supplement their growth. And then you get a middle ground between high growth and dividend shares. But fundamentally, owning shares means that you take part ownership of a company that you are inspired by, or that you believe the future prospects for that company are significantly greater than their past, or for companies that have got a really good track record of developing profitable income streams that you want to participate in.
Unit trusts and then exchange traded funds is also familiar to some people, to others not. But maybe you can just explain to us the difference between investing in shares compared to investing in a unit trust or an exchange traded fund.
Yeah, good question. I mean, to start with, obviously, when you invest in a share, you're investing in a single company, and your outcome is determined by the profits or losses associated with that single share or single company. When you invest in a unit trust, you're buying the philosophy of an asset manager to manage your money in a way where that you back him to buy the shares that will give you the best return for your capital. And he then goes on, that asset manager then has the mandate to go on and buy the shares that he believes will give you the best return on that capital. And so you, in a typical unit trust, will average, no less than 20 shares in a single unit trust, probably on average, and in most instances up to 80 or 100 shares in a single unit trust. So when you buy a unit trust, you're buying a manager's ability, an asset manager's ability to manage your money better than you can by buying the shares that he would buy with your money. And then an ETF is, in South Africa, we only have one flavor of ETF. It's called passive ETFs. And essentially, a passive ETF is a selection of shares that are constructed to follow an index or a theme. So let's just use one that's nice and simple. The Satrix AllZ 40 ETF is, as the name suggests, it is the top 40 companies on the JSE, and Satrix, as the manager of that ETF, have got no discretion about what shares they should buy for you. So you're not buying a manager's strategy. You're just buying access to a basket of shares that are constructed by an independent index. In this case, the one I've used is the AllZ 40. But you can buy an ETF on the NASDAQ 100, which is the top 100 shares on the NASDAQ, or the FTSE 100, which is the top London-listed 100 companies. So an index, typically, you are buying access to a basket of shares that are constructed externally by reference to an index or a theme. And the difference, therefore, between a unit trust and an ETF is that in a unit trust, you're buying the ability of a manager to buy and sell shares on your behalf, whereas when you buy an index, you're just buying access to a basket of shares without any manager's influence of what those shares should be. And I think the important part to understand is it's just a simpler way for you to buy that basket of shares. So if you had to go and buy 40 shares on the JSE, it would take you a lot of time and effort, and you would incur costs. But if you want to buy a single share, if you like, that has all of those 40 shares in it, then an ETF is the easiest and quickest and cheapest way to do that.
If you want to invest in shares, then obviously something that's quite important is all the different industries, and you need to know kind of what's your kind of strategy and what's your goals that you want to achieve. But maybe you can also just explain to us about the different industries within the share market.
Yeah, so we categorize them, the JSE categorizes shares into the various industries. So for example, financial services, which will include your insurance houses, your banks, your underwriters, who else is in that category? Asset managers will be there, stockbrokers, they will be under your financial services. Then you've got your resources sector, which is your gold miners, your platinum miners, anyone who is extracting resources from the ground. You've got your retail sector, and a whole plethora of other sectors on the JSE. Essentially, each of them represent a theme, and they just, what it does is it categorizes all of the companies that are competitors to each other in a specific sector, so that you can compare them easily. So if, for example, you're looking to enter into financial services and you want to get into bank stocks, you would just look under the banking sector. You'll see all of the 5 or 6 listed banks that are there, and you can compare those shares and then choose the ones that you think are going to perform better. So Capitec over FNB, or FNB over Discovery, or Discovery over Absa or Nedbank. So really just the sectors are themes or categories that categorize competitors under a single heading. And depending on the JSE, I think there are about 8 or 9 sectors. In places like America, there are 20 to 30 sectors. They have a much broader spectrum. You've got things like biotech sector, fintech sector, and a whole lot of other ones. But yeah, essentially all it is it categorizes competitors under a headline or category.
So to talk about local shares where you invest in South African companies compared to investing in global shares.
Yeah, so South Africa's, we've got 400 listings in South Africa, so 400 shares that you can buy. It's interesting, 60% of the earnings of those companies roughly come from international. So when people look at South African shares, you mustn't think that they only create their economics out of South Africa. And, the biggest and best example of a South African company that's deriving most of its income from overseas is Naspers. So, it's the biggest share on the JSE, and a lot of its income and growth has actually come from foreign. So when you think about South Africa, don't just think about the fact that it's South African companies only doing business in South Africa. Yes, there are companies like that. But for the most part, a lot of South Africans have exported themselves into other jurisdictions and therefore are earning foreign income. But essentially, the companies that you can buy on the JSE are the brands that you will know and understand and have grown up with. Things like the ones I've talked about: Capitec, Absa, Nedbank, Discovery, Pick n Pay, Woolworths, and the list goes on. And then obviously the ability to buy international shares means buying into international companies that are listed on foreign exchanges. So if we take the US shares, they're listed, there are 6 different stock exchanges in the US, and from NASDAQ to the New York Stock Exchange and others. And essentially those are companies that so we would have all got familiar through our smartphones, things like Apple and Google, Facebook, Twitter, Uber, etc. So essentially, a share is denominated in the currency on the exchange that it's listed in the country that the exchange is listed in. So Apple is a dollar-based stock because it's listed on the NYSE and on NASDAQ. And South African JSE shares are listed in South Africa on the JSE and are priced therefore in rands.
Okay. And then on the EasyEquities platform, you will have access to both local and international shares. That is correct, eh?
Yeah, so for now, you've got access to the JSE, so South African shares, you've got access to US shares, and we recently launched access to Australian shares as well. And within the next 3 or 4 months, we will add access to European and UK shares as well. So we're growing access to more and more markets as South Africans want to invest in more jurisdictions.
I think something that we should also just clarify is that sometimes there's quite confusion in terms of investing in shares compared to trading in shares. And you can maybe just explain that difference to us.
Yeah, so, trading is about buying a share in the hope that you're going to generate a profit in a short period of time, days, weeks, maybe months. Whereas investing in shares is about investing in companies that you believe are going to generate or outperform over a long period of time, typically 3 years plus. And the longer, the better, Warren Buffett said it best, invest in companies that you've fallen in love with and don't sell them until you've fallen out of love with them, and so the difference is really investors fall in love with the stocks that they own, and they own them for a very long time. They marry them. Traders are dispassionate about their shares. They've got no relationship with them. They just believe that there's going to be a short-term correction in the share price that they can benefit from, and they are speculating on that. They understand what that short-term direction is going to be, either up or down. And I guess that's another distinction, is that traders tend to be able to make money from stocks going up, but also stocks going down. Investors only make money from stocks going up because they buy and hold.
And I think for a lot of people, they consider shares to be a very high risk type of investment. But if we can also just talk about what are the risks involved and how best to mitigate those risks.
Yeah, I mean, it's an interesting topic, risk, because I think our perception of risk is clouded because of the headlines that dominate. So, for example, when people think about investing in shares, they think about Steinhoff, we've had one Steinhoff in the last 3 decades, so it's not about investing. The risk is that when you buy a stock, the value of that stock can go down. And in an extreme circumstance like Steinhoff, the stock went down 98%, which means you would have lost 98% of what you invested. So that's the risk of investing in shares, is that they go down. How do you mitigate that risk? Is you diversify your portfolio, so you don't put all of your eggs in one basket. And diversification is a very healthy tool. And it should, you should look to never own less than 10 or 15 shares, which would then mean that you've got maximum 10% of your capital in a share. But typically, your traditional asset managers or advisors would say to you, the right diversification is not just about the number of shares, but the jurisdiction of the shares. So, you should not just be invested in South African companies. You should be invested in European companies and American companies. You shouldn't just therefore have rand risk in your portfolio. You should have some dollar risk and some euro risk. And so diversification is how you mitigate losing a lot of money in a single stock. And essentially, if you're looking for an ideal kind of portfolio, my advice is that you need to be globally own between 40 and 60 shares across 3 to 4 different currencies and jurisdictions. Anything more than that, I think, is just too much diversification, which will ultimately erode returns. One of the things I do want to touch on, though, when you talk about risk, because I think it's the risk that's not understood, is the question you have to ask yourself is, what is the risk of not investing in shares? And I think the answer to that unlocks whether or not it is acceptable to you to not be investing in shares. And the risk of not investing in shares is the risk of not having a better future than what you have today. One of the things that all the wealthiest all have in common is that they all invest in shares, all of them. They're without it's without any qualifications. And so in order to create wealth, you have to have shares in your portfolio. And the risk of not investing is that you'll end up in asset classes that underperform inflation and don't create that wealth for you. So fundamentally, the decision you've got to become comfortable with, as when you're assessing risk, is what risk are you more terrified of? The risk of losing money, or the risk of not securing a better future for you and your family. And I think when you weigh those risks up, everyone I've ever met has always said, I want a better future. I want to be able to get better outcomes than I've got for myself. And if that's the answer, then the only alternative is to become comfortable with the other risks and mitigate them. I think too much time is spent by investors worrying about the risks of investing and then not investing, but never considering the risk of not investing and what impact that's having on their wealth creation.
No, I think that's a very valid point. And then I also believe that with financial education, and if you educate yourself about the companies out there, about the stock market, and you become more comfortable, you also make more informed decisions, because it will go up and down, and don't stress when it goes down. Hang on to it. Don't just sell when it's at the low. I think once you become more comfortable, or once you are more educated, you definitely make better decisions as well. But then,
and sorry to interrupt you, but I think the key there is invest a little amount of money in things that you don't understand, and you invest more money in things that you do understand. Why I say invest a little bit of money in things that you don't understand is that is going to be your path to understanding that asset class. And everyone starts by not understanding anything. When you start out, and that's one of the beautiful things about EasyEquities, is you can literally start with 100 Rand and buy 10 Rand of 10 stocks, or 1 Rand of 100 stocks. The education you're going to get from that real investment, though, you're going to get access to the AGM, you're going to get access to the annual financial reports, you're going to get newsletters from the CEO, you're going to get research from EasyEquities. That education is either going to grow your confidence in that stock and understanding, which is going to lead you to investing more, or you're not going to like what you see, which means that you're not going to invest more in that company. So the key to investing is to start with a small amount of money that engages you and leads you on a path to a better understanding. And as your understanding and knowledge grows, then you can grow your size of your investments.
No, I absolutely agree with you. But I think then there's a lot of people out there who would ask, but if I want to start investing in shares now, what do I need to look at before investing in a share? Is it financial statements? Is it share price? Is it the management of the company? What are the things that I need to take into account?
Look, to start with, invest in the companies that you love. And I really mean that. Like, if you think about the products in your life over the last decade, let's not go back further than that, but over the last decade, the products that have radically disrupted your life and you fell in love with, your cell phone provider, your insurance, your bank, companies where you spend your income statement, i.e., if you looked at your bank statement and said, well, where do I spend all my money? Woolworths, ShopRite, whatever they might be, start with those companies that you've already got a relationship with, that you're already fallen in love with, because typically they make good investment choices. If the lines outside Capitec at payday are longer than the lines outside Nedbank on payday, then there's something being said about the fact that Capitec is accessing that market. So start with the businesses that you've already fallen in love with. Now, what that will do is that will lead you on a journey to better understand, I love these products, but what are they doing differently that sets them apart? And then you can read the annual financial reports and the financial statements. You can get involved in online, especially social platforms. Facebook, Twitter are magnificent. You can follow the world's best asset managers, the world's best investors. They're all on Twitter. So you can go and follow a few of them, and they share their opinions on these stocks. There are forums like Reddit and Facebook. In South Africa, the EasyEquities Facebook forum, the biggest one's got over 100,000 people. It's not our forum, somebody created, and this is 100,000 people sharing their ideas and talking about stocks and sharing their research and understanding. So the big enabler for education is actually community. So get involved in these online social communities, listen, ask questions, read, seek to understand for yourself, but start by buying the shares you've already fallen in love with. Whether it's Samsung or iPhone, to just look at your handset and tell me which one you've got. Where do you bank? Which are you, MTN or Vodacom? It's simply that. And I promise you'll lead yourself to a portfolio of 10 shares without even thinking. And then your relationship with your investments will start, and you'll get involved in communities and online and social. And then your education, it never ends. The journey, you will never understand everything you need to understand about investing. I mean, Buffett is over 90 years old now, and he still says he's learning every day. Well, none of us are 90, and we've got a long journey before we get there. So don't sweat your having to do anything other than start buying the shares you've already fallen in love with, and then let your journey start.
And then what about brokers? Do you still need a broker, or how do you know when is it necessary to go through a broker and when can you just go directly?
Yeah, so if you believe you have the tools and access to do it for yourself, then you certainly don't need a broker. You could just come to EasyEquities and do it for yourself. Having said that, if you feel like you still require guidance, there's too much uncertainty, there are things that you want to understand, that you want to navigate and be educated on, and you don't have the confidence to do it, then I would say you should reach out to a broker in those instances. But fundamentally, understand that if you're reaching out to a broker, then you must be prepared to pay, because fundamentally you're leveraging that individual's education and understanding. And the one thing that I've learned, and I'm 47 years old, is that the greatest investment you can make is in yourself. And in that respect, rather spend the time improving your skills and understanding than paying for those services, because investing is a life skill. Once you start, it's something you're going to be doing for the rest of your life. It's not something that you trend into. It's not like water skiing that's only good in the summer. This is something you do all year round, and you're going to get better and better at. So I would encourage you to do it yourself, but to grow your understanding and therefore your investments over time, not to rush in too fast, and take ownership and educating yourself. I mean, the one thing the internet has done in the last 2 decades is it's democratized access to education and information. Everything your broker needs to know is available to you to know too. So I'm a fan of people doing it for themselves, because I think that nobody will look after your money as well as you will.
No, I totally agree with that statement. But Charles, I think there's also another misconception where a lot of people believe that investing in shares is only for rich people and you need a lot of money to invest in shares. And you have already touched on it, but do you need a lot of money to invest in shares?
Look, until EasyEquities launched 6 years ago, you did. You know, the minimum investment values were around 5,000 Rand. And minimum trading costs, it used to cost about 80 Rand to buy a single share. So you say, that's expensive. I mean, there are not many things that you buy that cost you 80 Rand. So for a single service. So EasyEquities has changed that. You know, if you can literally start with 50 Rand or 5 Rand or 10 Rand, but let's keep the maths nice and simple for me, and let's keep it at 100 Rand. Our transaction costs are 65 cents for every 100 Rand invested. So if you invest 100 Rand, 99 Rand and 33 cents, 33 cents. No, I was right. 33 cents gets invested in the stock that you want to buy. Before we were around, that 100 Rand would have only got you 20 Rand in stock and 80 Rand in costs. So that we've eliminated the barrier around costs, and there are no platform fees. There's no monthly fees. There's just the only time you pay is when you invest. And as I said, 67 cents per 100 Rand invested. The other thing that we've done to make access more affordable is that we recognize that share prices themselves are exclusionary. So let's just take the most expensive share on the JSE. It's Naspers. It's a 3,000 Rand stock, and not many South Africans have got 3,000 Rand, but everyone should be invested in Naspers. It's a great company doing great things. But we fractionalize access. So now you don't have to have 3,000 Rand. You can literally buy 1 Rand of Naspers or 10 Rand or 20 Rand. So the excuses that I don't have enough money have gone away. We've got literally thousands and thousands of investors who started their journey with 50 Rand and are saving 5 Rand a day and investing in the stock market. So yeah, don't be intimidated. I think the other point to make is that whether you've got 5 Rand or 5 million Rand, you get exactly the same service from EasyEquities. There's no difference. It's not cheaper for the rich and more expensive for the poor. It's exactly the same.
Yeah, and I think I also always encourage people to start off small. If you are not comfortable, start off small, but the most important, at least make that first initial step and then you grow it from there. But yeah. you have taken us through the costs involved, but I think something else that we also need to consider would be any taxes. So maybe you can also just touch on what's the tax implications.
Yeah, so SARS sees taxes individuals in 2 ways when it comes to investing and trading. So traders, it's deemed as income and then falls part of your income tax. So whatever income tax bracket you fall into, you would pay. And essentially what SARS is looking for is the behavior of your activity. So if your behavior is you typically hold stocks for a couple of days, you're not going to be able to convince SARS that you're an investor. And so SARS is going to treat you as a trader, and then you're going to pay income tax. If you are an investor, and then the definition will be that your intentions are long-term, i.e. your intentions is to hold these stocks for a longer period of time, and that's evidenced in your holdings, then you pay capital gains tax. And your capital gains tax is a fraction of your income tax. So typically it's about a quarter of it's about a third of your income tax. So if you're a 40% taxpayer on income, your capital gains will be roughly a third of that. So investors get the benefit of capital gains, which is a third of your income tax rate, roughly.
I think a lot of people would say, okay, we want to start off investing in shares, or we already have a share portfolio, but I want to become successful as a share investor. So what tips do you have for people to really become a good and successful investor?
Look, I think you must have you've got to read to start with. I mean, there's some great books, The Intelligent Investor, Rich Dad, Poor Dad. What else? What am I missing? Yeah, those two are great reads for any age group, starting with Rich Dad Poor Dad. But then the most powerful education for me is in social media. The fact that I can follow Warren Buffett on Twitter is just incredible, and there are lots of people just like him that I follow on Twitter. There's some really great South African personalities who publish their stock advice, not advice, but their stock tips, what they're buying and what they're selling, and you'll find them easily. And then the best education I've ever got in investing is reading the annual reports of the best CEOs in the world. I mean, my investing grew up reading Jeff Bezos's annual report. I mean, he writes a letter every year to shareholders, and he talks about what he did wrong and what he did right and what's driving his thinking and decision making. And the day I became an investor in Amazon is the day I got access to those letters. And the same applies to people like Elon Musk and Steve Jobs, now Tim, and other CEOs, Gerry in South Africa, and other CEOs that inspire you, that have built wonderful South African companies. Once you invested in their companies, you get direct access to ask them questions, read their annual reports. And so you've got to be an avid reader. You've got to be active in social spaces. You've got to read the news and read a few books as well. And the more you do of that, all of that, the better you're going to become at it. And I think every time, remember the reasons why you bought a share. And until those reasons are no longer prevalent, then you sell the share. And then when you sell the share, always reflect on that decision. Not at that point, but a year later, just see what the impact, did you sell it too soon? Did you sell it too long? And then hold it too long? Could you have done better? Reflect on that from time to time. I mean, I take the time to look at my portfolio literally every day, which I think is probably too much, but I only reflect on it once a year. I look at the things that I bought and the things that I sold, and I'm critical of whether I, made the right decisions. And then I review why I made those decisions and try and learn from my mistakes. So I'm just trying to get a little bit better every day. I mean, what is interesting is you only have to be right. I think the maths is 40% of the time to be a successful investor. The key, though, is that if you improve that 40% track record, then you can become a super investor like Buffett. So constant learning, constant hamster wheel of learning and educating and querying and understanding and reflecting on your failures.
Okay, now I absolutely like that response. Jules, I think something else that we have touched on, but maybe we can go into a little bit more detail, is just the difference between your growth shares versus your income shares. So maybe you can just explain that to us in a bit more detail, please.
Yeah, so your income shares, or what they call dividend yielding shares, they're companies that are typically very mature, which means they've been around for a long time, in industries that they are fairly dominant in, and they're producing a very strong cash flow and high profitability, and they've got nothing to do with that profitability other than to give it back to shareholders. And that would be, if I gave you an example, that would be like, let me think of a company that's not investing in growth. Let's take SAB as an example. It's no longer listed in South Africa, but SAB was the dominant beer producer in South Africa. There was very little need for it to go and invest in new breweries or new market share, sort of owned the market. And so it had nothing to do with its money other than give it back to its shareholders. And so it became a high dividend yielding stock. The opposite of that is a younger or more innovative business that is growing really fast, and that growth is consuming all of its profitability. So it's taking all of the cash that it's producing and investing it in its own growth story. And that's in growing its products and growing its jurisdictions and its regions, its services, its team. You can imagine this, business that's consuming all of the cash that it's producing. And therefore, it's got a better use of its money than giving it back to its shareholders. And, growth companies, the ones that have dominated the headlines, over the past year are the tech stocks in the US. the Amazons, Facebooks, Apple, Alibaba, Google. These are companies that are growing, still growing really, really fast. Despite the fact Apple's been around for 3 decades, they're still growing really, really fast. And they are holding on to all the money that they've generated, all of the profits, and reinvesting them in new things. So Apple, every year invents a new version of the iPhone, the iWatch, the iPad. It's thinking about an iCar, etc. So they are operating in high growth industries that demand them to use their capital to keep growing. And one day they might turn into dividend stocks when that growth trajectory runs out. But for now, they believe that they are better keeping their money and using it to grow their products and services. Tesla is a good example in the last year. And South Africa, we're a growth stock. So I'm a small, Purple Group. It doesn't pay dividends. We take all of our profitability and reinvest it in our own products and services and growth. Naspers would be another example of a growth stock in South Africa.
I guess it's also about what's your intention and your goals, whether you are more interested in earning a good income compared to whether you rather want the capital value of your share portfolio to grow.
Yeah, and I guess it does become quite age related. So younger investors have got more time and therefore can take more risk. So typically an investor's portfolio who's in his 20s or 30s will be dominated by growth stocks. As you get older, hopefully you've achieved your investment goals, and actually income is more important to you because you want to sustain your lifestyle because you're no longer drawing salary. And then your portfolio will be more dominated by income stocks that pay you a healthy dividend, which create your income, which sustains your livelihood in retirement.
Charles, I think we have discussed a lot and you've shared a lot of knowledge. But for somebody who said, now, okay, I've listened to this, I feel more comfortable about investing in shares and I would like to give it a go. How and where can people start off when they want to start investing in shares?
Cool. So just go to easyequities.co.za, click on the register now button. The registration process takes a couple of minutes. You can submit all of your documents electronically, so there's no need to submit documents via email or otherwise. And you can literally then, once your account will be open in minutes, and then you can deposit money either by EFTing it to us or by using your debit or credit card. And from then on, it's literally click on the shares that you love and go and buy them. And if you can't think of any shares to buy, then buy some of the ETFs rather, like the Aussie Satrix 40, which will give you a diversified portfolio very quickly. But start. The key is start. The other thing to say is we've got a demo account, so you can register and open an account and use Play Money on real markets. So it's real markets, real time, but Play Money. And you can build your confidence with Play Money and then start with real money. My advice to you is start with real money, because I don't know how much you've ever learned from playing Monopoly, but for me, the real lessons in life are felt with real money. But start small. Real money is 100 Rand, and that's not a lot of money to kick off your investment journey.
Absolutely. And I think just one last thing that we didn't touch on would be the liquidity for people who would say, okay, but now I've invested my money, but now I need my money urgently. Can I have quick access to my money again?
Yeah, so when you sell shares, it takes 7 days for that money to settle. But typically and that's 7 business days. So that's, that takes a bit of time, but you can early settle it. So we've got a facility on the platform, which means that you'll get your money back within 24 hours, and it costs you 0.2% to early settle it. So, that's 20 cents on a Rand, on 100 Rand. So if you had 100 Rand to withdraw and you wanted it tomorrow, it would cost you 20 cents to get that money back tomorrow.
I want to thank you for spending some time with us. Thank you for sharing your knowledge and wisdom. I think a lot of people have learned a lot today. And I'm going to, for the viewers, I'm going to share the EasyEquities website details so that you can go and have a look, and that if you are interested, you can go and register. Just another thing to remember, that whatever we are discussing today, it's purely educational, so we are not giving any financial advice. If you are uncertain or you want to check something, please go check it with your financial advisor, your accountant, tax consultant, or whoever that person is who can help you with your personal finance. Thank you to all of you who have been watching this interview. I hope you have enjoyed it. Remember to subscribe to the channel, and if you have any questions, please put it in the comments and we will get back to you. Then I will see you again at the next Ronel Talks Money show.